is about the importance of context for traders. Some of what I'm going to say today is taken from my latest book, An End to the Bull, published by Wiley, which is available both online and from traditional bricks and mortar bookstores. In my previous presentations, and also in my first book, Technical Analysis and the Active Trader, I discussed the failings and the flaws of technical analysis. And one of the key failings of technical analysis is that it ignores context. It looks at data alone, and it suggests that the context of that data is not relevant. I'm going to say to you that that's a shortcut and that context is very relevant. This is Santos, an Australian oil stock. As we've seen over the last few months, this stock has fallen sharply, in particular on here and here. Now, sure, the technical analysts can talk about this in terms of levels it's rejected, support levels, resistance levels broken, all this kind of stuff. But the reality is that this move is in the context of a sharply falling oil price. Everything that's happened here is under that context. I'm not saying that this will mirror one for one the price of oil, but the reality is that this is the context of the moves that we have. On the days where the price of oil fell sharply, this stock fell sharply too. Is this a bottom? Is this a bottom here forming? Well, I'm going to say to you that depends on a few things, but the context of what happens to the price of oil and how this company now goes going forward is crucial. If this stock holds around here, it's not because of this level. If the price of oil halves from where we are now, this level is irrelevant. This stock, I'm telling you, will fall. If the price of oil doubles, this stock will rally. That's how it works. That's the context of these situations, and that's how we make decisions. All assumptions of this stock, how it's going to go, this company in the future, is based on the price of oil. And daily, weekly, monthly, we're trying to assess any changes to that. But it's not the price level that this market reacts to. It's the context, and that is an important difference. Here too, Fortescue Metals Group, an iron ore mining company here in Australia, continued decline from $6 to $2 under the context of a continual decline in the price of iron ore. That's the context. If that changes, if the price of iron ore continues to rally now or starts to rally, then you'd expect this stock to recover. In terms of the levels created here, well, they were created under a certain context. If you change the context, then these levels are irrelevant. They don't mean anything under different circumstances. When people were trading in these times, they were doing so under a context. They weren't reacting to the level. Oh, today this level here, we don't like it, we're going to sell. What they're saying is the price of iron ore keeps falling. It doesn't really matter what individual levels there are. As you can see, there's no support in this market because the price of iron ore keeps falling, this stock will keep falling. The problem for technical traders is, and for all traders, is that when you look back, you don't know what the context was. So therefore, the decisions you start to make, the assumptions you make, are less valid. You need to know, why did this happen? If you don't, you could be missing a big part of the picture. This is SanDisk, US stock, a storage device manufacturer. Recently had a sharp fall. It didn't reject this price. And when you go into the future, you'll have a look at all these prices. What happened was it announced really bad earnings and the stock fell. I'm saying to you, it doesn't matter what price this was trading on the day. If anything around this level, doesn't matter. This stock would have fallen with bad news. It doesn't react to this price, it reacts to the news. But fast forward a few months, let's say this move becomes this one. We don't know what happens. A new person looking at that just looks at this stock trading up and doesn't know what's happening. It's important to know that it wasn't this level. So when we look at the future, and if this stock starts to rally, I wouldn't look at this level as anything important at all, because it didn't reject the level, it rejected the news. And that's very important. Just as an aside, it's interesting to see here, if we had back tested SanDisk over this period here, We would never have seen that a move like this was possible. It's one reason, as I talk about in my first book, why backtesting doesn't show you all the risks of a trade. It only shows you what's happened. This move would have been an unforeseen event that couldn't happen, but of course it can happen. So coming back to context, context is really important. When you look back at a graph, we haven't got any clue of the context. If I look at a chart of something, it means nothing to me without understanding why did it happen. As an example, a non-trading example, I'll discuss the 2002 Winter Olympic speed skating final that involved Stephen Bradbury, an Australian. At the last lap of his speed skating final, Stephen Bradbury was in last place. But then the first three tripped up on each other, all fell over, and he came through on the outside and skated easily over the line for a gold medal. Now if that race was to be rerun, and I got two bookmakers in to make prices on that race, one of them, I just show him the data, just like we see here, first, second, third, fourth, the result only. The second one, I show him the race, the recording of the race, he can see what happened, the context of the race. I'd suggest they'd make two very different set of prices of what will happen the next time. One of them, the one who just looks at the data, will say Bradbury's favourite, he's the winner, he must be the best. The other one will make a decision of, well, another fall is unlikely, therefore the result is unlikely to happen again, I need to understand the context. Now which one of those two do you think will have a longer career as a bookmaker? One who looks at context or one that doesn't? I'll suggest to you that it's important to understand context. Essentially, when you look at a graph or any data, if you put this data into a system and try and backtest it for highs, lows, risks and everything else, you're missing the context. You are only looking at the result, like the bookmaker that just looks at the result of the Bradbury race. You miss a huge amount. Now yes, it's more work, potentially more difficult to understand the context. Sometimes it isn't. This move here is pretty easy to understand what's going on. But sometimes it's more difficult. But trading is more difficult. People that offer you shortcuts, like using these levels, this reacted to this level, it reacted to that level, they're just offering you a shortcut. But shortcuts in this business are usually shortcuts to failure. That's why specialists have edge, and I talk a lot in my books and when I'm teaching my clients to become specialists. If you're a specialist in something, you have edge through understanding context. And when I trade and when I teach people to trade, I talk and I explain to them the importance of context and how to work that out. If you trade without context though, just understand you're missing a huge amount of what's really happening. And any decision, analysis, risk analysis or direction analysis that you make will be deeply flawed. So hopefully you'll understand that whilst missing context makes trading easier, whilst using levels and price levels only makes trading easier, it doesn't make trading better. An understanding of context will be crucial if you want to start making better decisions.